Welcome back to Money Wisdom with Angie. In today's chapter of Midlife Mark's Financial Reset, we're diving into a crucial yet often misunderstood part of financial planning. So, what actually happens to your pension when you die? Let's assume Mark's retirement pot has grown to £250,000 in the UK and around $315,000 in the US. But he's now thinking beyond the numbers, toward the legacy he'll leave behind. Let's explore how pensions are treated after death in both the UK and the US, so your hard-earned savings go to the right hands. First, we will take a look at state pensions in both the UK and the US. In the United Kingdom, the basic state pension and new state pension stop upon death. They cannot be inherited. However, a spouse or civil partner may inherit part of the deceased additional state benefit or protected payments, depending on the individual's national insurance record and when they reach state pension age. If the deceased deferred their pension, a lump sum or increased payments may be payable. And here's a tip. It's best to contact the pension service for specifics. Moving on to the United States, Social Security provides survivor benefits to eligible family members. A surviving spouse may receive up to 100% of the deceased's benefit, depending on their age and own benefit status. Children under 18 or 19, if still in school, may qualify for support. And here's a tip. Do contact the Social Security Administration, the SSA, promptly after death. In part 2, we will look at private pensions in both the UK and the US. Now, in the United Kingdom, let's look at these two types of private pension categories. Number 1, defined contribution or DC pensions. If you die before the age of 75, your beneficiaries can usually inherit the pension tax-free. If you die after the age of 75, inherited pension income is taxed at the recipient's marginal rate. Now, here's an important update. From April 2024, it is proposed that pensions will no longer be exempt from inheritance tax, IHT, in some cases, but this is under consultation and not yet law. I suggest you monitor updates carefully. And number 2, defined benefit, DB pensions. These typically offer a reduced survivor pension to a spouse or dependent. Each scheme has its own rules and options. Contact your scheme provider. And in the US, under the 401ks and IRAs, spouses can roll over the account into their own IRA, allowing for tax-deferred growth. Non-spouse beneficiaries typically must withdraw all funds within 10 years under the Secure Act. Distributions are taxable as income. In part 3, we will look at nominating beneficiaries. Wherever you live, naming beneficiaries is essential. These are the action steps you should take. Regularly review your nominations, especially after major life events. Number 2, ensure your pension provider or plan administrator holds the correct information. And here's an important reminder. Wills do not override pension beneficiary nominations. Your expression of wish or beneficiary form takes precedence. Next, we can never go very far without looking at the tax implications. In the United Kingdom, the inheritance tax, IHT threshold, is £325,000 with an extra £175,000 allowance for passing a main residence to direct descendants, known as the residence nil rate band. While pensions currently fall outside the estate for IHT, proposed changes may affect this in future budgets or legislation. Always seek updated advice. Moving on to the situation in the United States, there's no federal inheritance tax, but estate tax applies for estates over $13.61 million in 2025. Some states levy separate tax or inheritance taxes. Check your state laws. And beneficiaries of 401ks or IRAs will pay income tax when they withdraw money. I think Mark needs a checklist for all of this. So let's give Mark and you a checklist to protect your legacy. Number 1, name your beneficiaries. In the UK, complete an expression of wish form for each pension. In the US, update beneficiary forms for each retirement plan. Checklist point number 2, understand the tax rules. In the UK, if you die before 75, it's a tax-free pension inheritance. And after 75, income tax applies to withdrawals. Do watch for future IHT changes. And in the US, spouses can defer tax via rollover. Others must withdraw within 10 years. Tax planning is key. And checklist point number 3, do get professional advice. In the UK, seek out a chartered financial planner. And in the US, look for a CFP or fiduciary advisor. Ask about using trusts, IHT mitigation, and coordinating pensions with your will. Checklist point number 4, do review every 2 to 3 years, or when you experience 1, marriage or divorce, 2, birth of a child or grandchildren, 3, illness diagnosis, 4, retirement, and 5, tax law changes. Finally, moving on to checklist point number 5, leave simple instructions and do document 1, pension provider contact information, 2, beneficiaries, 3, advisor details, and 4, any personal wishes or funeral preferences. So to close, building your pension pot is vital, but passing it on wisely is just as important. With a bit of planning, you can leave your loved ones a financial gift, not a tax headache. If you found this helpful, like, subscribe, and join us again soon on Money Wisdom with Angie. And if you have any questions or experiences to share, do comment below. We'd love to hear your story. Until next time, keep your finances calm, clear, and working for you.